Very good morning, friends. So I hope everybody is doing good, and we are now waiting for the next year to come. So this is the last day of 2024, and thereafter we welcome 2025. So today, being the last day, we've got some very interesting, I would say, bouquet of standards awaiting for you. So we're going to start today I would say, the set of standards which deals with consolidation. Now, why did I say that the bouquet of standards, which awaits you in terms of consolidation? Because when you're looking at consolidation in terms of Ind AS, there are a lot of standards dealing with the issue. So what I'm going to do at the very start, introduce you the name, the numbers of the standard, and the standard deals with what particular area. Because as we're going to go deep into each and every standard, I think it's first important that, first the chain of thought gets sink in, that which situation, which standard is going to apply. Because I think one of the most important inputs, what I believe is that when you look at a particular accounting transaction or you look at an accounting event, you should be able to first of all zero down that in this particular case, this particular Ind AS is going to become applicable. Sometimes I've seen, people do get a confusion in terms of deciding that in this particular situation, which Ind AS would apply. So to make your life simple, at the very start, what I'm going to do, I'm going to give you a very simple step-by-step approach. And I'm going to give you a three-step model, which will introduce you to the various set of standards which are there on consolidation level. And some of these steps, of course, are involves a little more inputs, which we'll discuss slowly and steadily. So don't get worried on certain terminologies as we go across. To begin with, of course, is going to be a very simple affair. Though I think you can see that I have, put at the background Ind AS 103 on business combination. Well, that would be one of the triggering standards we will start with. But I think before that, let's introduce you to the chain of standards which are there on consolidation. So let me just give you a simple three-step model. So let me give you, first of all, a simple three-step model to decide which standards will trigger in which permutations and combination. Well, let's take a little simple example at the background before we take the three steps. Let's consider there is a company A and the company A approaches company B. So let's say, for example, there is a company A Limited and it is approaching company B Limited to buy something. Mind the words carefully. I'm very carefully choosing my words. That A Limited approaches B Limited to buy something. I did not say that he bought his business. I said A approaches B Limited to buy something. So I'm going to put across a question number one. What did A acquire? So when I say that A went to B and said, I want to acquire something, I'll put a question, what did A acquire? So my step number one would be to put across a question. What did A Limited acquire? So I'm taking A Limited as a base in my example and putting across a question that what did A Limited acquire? Now, the answer which I can get is he acquired maybe an individual asset or he acquired, we can say, a group of assets. Mind the words carefully. So when I say what did A acquire, my answer would be that A acquired an individual asset or he acquired a group of assets. Now, when I say the word group of asset, it does not mean that it is just a group of assets. It can be with or without liabilities as well. So when I'm using the word group of assets, it would mean it can be with liabilities as well. So when I put across this question that what did A acquire, I would get an answer that he acquired, for example, an individual asset. So he acquired an individual asset, for example. Or we said he's acquired a group of assets. That means more than one, of course. And when I said group of assets, I made it very clear that this group of assets could be, with or without liabilities. It could be with or without liabilities. So not necessary that it is just assets. It can be coupled with liabilities as well. Now, one thing is pretty simple and logical indeed, that if A acquired an individual asset, consolidation standards can never trigger. So in this particular case, I'll put across another question to myself, that if he acquired a good individual asset, I'll say, okay, let me put across another question to myself. And let me ask myself that did he acquire a tangible asset, or did he acquire an intangible asset? You see, we're very systematic in terms of putting a questions to ourselves. So we're saying that did he acquire a tangible asset, or did he acquire an intangible asset? Now, if he's acquired an tangible asset, would you like to make a guess in terms of which index would trigger? You've done some standards which are dealing with tangible items, and you've done some standards which are dealing with intangible items. Would you like to make a guess in terms of which particular standards would trigger in this case? So you know that when we're looking at tangible items, there is PPE, property, plant, equipment, Index 16, or there is investment property, which could be Index 40. But if it is intangible in nature, then it is Index 38, which talks about intangible assets. That's wonderful indeed. That's correctly given. So if it is a tangible assets, then depending upon the parameters, it could be Index 16 or 40 as the case may be. 16, to remind you, is property, plant, equipment, and 40, to remind you, is investment property. And when you say that he acquired, let's say, an intangible asset, then in this particular case, Ind AS 38 would apply, and which talks about intangible assets. But of course, consolidation standards would of course not apply. I think life's simple. So I need to go very systematic and put across a question, what did A acquire? So if I say it is individual asset, then depending upon the nature of the item, the relevant standards would trigger. Then comes, if he's acquired a group of assets, I will go to step number 2 and then decide further. I don't think so any further explanations on step number 1 is required. I think the step number 1 in itself is quite self-explanatory indeed. Okay, so let's go to the next step now. Once you've decided the individual or the group of asset, you need to go to the step number 2. Now, since you've zeroed down that you've acquired a group of assets, I need to now understand, is this group of asset supposed to be a business or not? Now, the question rises, how would I decide that it is a business or not? Now, in order to decide whether it is a business or not, what I need to do, I need to apply the principles of Index 103. Because Index 103 gives me the guidance in terms of deciding that whether a group of assets is a business or not. Now, we don't want to insert the discussion in between at this stage. So we will discuss those elements, that what decides a business, later. But of course, after this particular chart. So at the moment, just assume that I need to evaluate whether a group of asset is a business. What are the parameters to decide whether it's a business or not, given in Index 103? So we're going to put across a question, that is the group of assets. So we're going to put across a question, that is the group of assets a business or not? So the focus is to decide whether it is a business or not. Now, at this stage, let me, I think, add something more also to you. Well, I said to decide whether it's a business or not, I would take the guidance in terms of Index 103. But I think at this stage, let me insert some elements out here in your mind. There are basically two kinds of tests which are given in Index 103, which decides whether it is a business or not. The first one is supposed to be called a concentration test. And the second one is what I call it as IPO. It's not called an IPO, but I have nicknamed the second test called an IPO. You can, of course, call it as a three-element test. Officially, it can be called as a three-element test. That's called IPO. It's not initial public offer. It is input, process, output. Now, let's not get worried in terms of how these tests are conducted because we will understand those nitty-gritties later. But as of now, just want to put that in your mind that in order to decide whether it's a business or not, we need to apply. We need to apply the test. So we need to apply the test which is given in Ind AS 103. Ind AS 103 by the name is called business combination. Ind AS 103 is called business combination. So let me put that in the brackets as BC, that's business combination. And as I said, for your understanding later, that when you say we need to apply the Ind AS 103, there are two tests which are given in the standard. It is just to introduce you the nomenclature of those tests. How are these tests conducted? What are these tests? That we'll understand later. The first one is called a concentration test. The first one is called a concentration test. And the second one, as I said, officially can be called as a three-element test, or I call it as IPO. This is my nickname given. So it's better to use the word three-element test. But of course, I think even if you call it as an IPO test, it's not a problem, I guess, because IPO stands for those three elements: input, process, and output. So with the help of these two tests which are given in Ind AS 103, we will be able to evaluate whether a group of asset is a business or not. So we'll study these tests also in detail today only. So once you evaluate whether the group of asset is a business or not, your answer would be either a yes or the answer would be a no. So if you say the answer is a no, then in that particular case also, consolidation standards cannot trigger. Even if you're acquiring a group of assets, but it doesn't turn out to be a business, the consolidation standards cannot trigger. Then what am I supposed to do? Now, please hear me carefully, very carefully. If you're acquiring a group of asset which is not a business, Ind AS 103 does not apply, but Ind AS 103 gives you the guidance. So what are you saying? I'm saying that Ind AS 103 in this case is not applicable. But the interesting part is that Ind AS 103 still gives you a guidance of what is to be done. So we're looking at the guidance which is given in Ind AS 103. To avoid any confusions, I don't want to tell you, write it out here that Ind AS 103 is not applicable, but Ind AS 103 gives the guidance. I'll just give you what is the guidance in this case. So in this particular case, when you say that you've acquired a group of asset which is not a business, it basically means that you paid a consolidated consideration to buy certain group of assets. So what do you need to do? You need to basically go to the valuer and tell him that this is the consolidated consideration paid. Can you help me to segregate what is the individual value of these assets? So what would the valuer do in that particular case? He will split, you can say, the total consideration paid, the aggregated consideration paid in the ratio of relative fair value. Now you would wonder, why is this man saying very clearly relative fair value? There is a concept of what is relative fair value, which I'll explain in a practical illustration very shortly. So in this particular case, what am I supposed to do? We need to split the consolidated amount. We need to split the consolidated amount between various assets. We need to split the consolidated amount between the various assets in this particular case. The consolidated consideration which you have paid, we are going to split that consolidated amount between various assets, and this will be done in the ratio of relative fair value. Let's not get worried at this stage. What is this relative fair value? I will explain that with a small little example, which is also given in the study material. So in this particular case, what I will do, we will go to the valuer, tell him that, okay, this is what I paid in totality. Can you help me to split what is paid for every asset? He's going to split that in the ratio of relative fair value. And interestingly, after the split is done, in this particular case, I would apply Ind AS 16 or 40 to the tangible items, and I would apply Ind AS 38 to the intangible item. So thereafter, the same set of standards would become applicable. So it's getting complicated as we're moving to step by step. Yes, but it is easy. Don't worry, I'll consolidate the picture quickly. So in terms of the step number 2, when you said in step number 1 that I acquired a group of assets, the focus is that is the group of assets a business or not? So in this particular case, Index 103 is giving you a guidance to decide whether it is a business or not. And there are two kinds of tests which are given. You need to know the names at this stage: a concentration test and a 3-element test, what I call an IPO, input process output, with the help of which you will be able to zero down whether it is a business or it is not a business. If it is not a business, one thing is very sure: consolidation standards cannot trigger. But then I am supposed to go to the valuer and tell him that I paid a consolidated amount to buy these group of assets, split the amount. He will do this in the ratio of relative fair value. What is relative fair value? We'll see. Thereafter, the split, the normal standards in AS 16, 40, 38, depending upon tangible, intangible items would apply. And if you say, yes, it is a business, then I think you clearly know I am going to go to the step number 3 in this particular case. Wonderful. So which means my focus point in terms of step 1 is you need to acquire multiple assets. My focus in terms of step number 2 is the multiple asset is supposed to be a business. And then comes the step number 3 as well. So let's go to the step number 3 at this particular stage. Now this step number 3 is very crucial because this is going to give you a lot of permutations, combinations in terms of various standards which would trigger. So get ready for some more standard numbers coming to your minds at this stage. Now the next question we're going to ask ourselves is, did A Limited get a control? Did A Limited get a control? The focus now is on control. Did A Limited get a control over the business? Did A Limited get a control over the business of B Limited? Because when I said that A acquired a business of B, now the focus is, did he get a control over the business of B? Well, at this particular stage, it would be dangerous to tell you something, but I think I need to tell you. You know, when you look at control, it reminds you of your CA intermediate. And you remember that in terms of CA inter, we used to say that the control comes when you get more than half of the voting power in a company. Does Indus also works upon that kind of principle? The answer is no. Indus has given us what is called Indus 110, which deals with consolidated financial statements. Now, as far as the control assessment in Indus is concerned, it is not a rule-based assessment, but it is supposed to be a principle-based assessment. Now, you would say, what is a difference between a rule-based and a principle-based assessment? You know, in a rule-based assessment, you'll end up saying that if I get more than 50% stake in a company, I get a control. It's like, you know, a rule-based application. A percentage criteria is being applied and you reach a conclusion. But Indus 110 is talking about, you can say, a principle based assessment, which can give you very interesting results. Which means that a company may not get a control even if you get more than 50% stake. A company may get a control even if you do not get a 50% stake. You heard me correct. So, Indus 110 on the control assessment is a very principle based application. You know, the concept, what you might have done in accounting standard 21, what is there in the mind is that, okay, if I get more than half stake in a company, I get more than 50% voting power in a company, I get a control of the company. But in terms of Indus 110, this is not how it works. Now, let's not get into what kind of principles are given, because as we're going to go to the consolidation standards, we are also going to see how the control assessment under 110 is done. So in this particular case, all I will make a mention at this particular stage is that when you're looking at the control, we can say this control assessment. I would only put it like this, that this control assessment is based on Ind AS 110. So this is based on Ind AS 110, and for your reference, the standard is called Consolidated Financial Statements. And I just need to make a mention that this standard is a principle-based assessment and not rule-based. So we can just make a mention out here that this standard is supposed to be a principle-based application. It is a principle-based standard, and I think it's worth to make a mention, not rule-based. It is not supposed to be rule-based in this particular case. So I think one thing which I would like to also further make a mention is that when you're looking at that it is a principle-based assessment, we can say control may exist. The control may exist even if the percentage is below 50%. You get less than 50% voting power, the control may still exist. And also to make a clarification, the control may not exist. The control may not exist. So the control may not exist even if the percentage is more than 50%. That is the kind of subjectivity which can arise on the application of 110. Though we are not going to touch upon this particular assessment at this stage, this assessment will be learned in Indus 110. So at this stage, I'm not interested in learning that. But I want to tell you that it's not a rule-based assessment where you can say that if you got 50% plus, you get a control. So for the time being, of course, you can understand that, okay, if I tell you that I have got, let's say, more than a 50% stake in a company, by default, I would say there is a control unless proven otherwise, but largely a principle-based assessment. So once you made that particular assessment, whether A gets a control over the business or B or not, the answer would be a no, or the answer would be a yes. So the answer would be either a yes or the answer would be a no. Now I need to give you a lot of standards, so let me make a chart on the next page that if the answer is a yes or no, what is going to happen? Wonderful indeed. You must be thinking, this man since morning, almost around half an hour, is been introducing the concept of the various plethora of bouquet of standards. Wow. Okay, so let's take the journey forward, and we are now looking in terms of the yes and no. No worry, I will just quickly consolidate after the end of the discussions. I will consolidate the 3 steps model as well. So when you reach a step number 3 and you say that did we get a control, the answer is a yes or no. Now, watch this carefully. If you say the answer is a yes, then there are going to be a total of 3 standards which will trigger. The answer is a yes. There are going to be three standards which will trigger. The first standard which will trigger is supposed to be IND AS 103, which is called business combination. That is the first standard which will trigger. Let me first write down the name of those standards which will trigger, then I'll give you more inputs. The second standard which is going to trigger is IND AS 27, and that is called separate financial statements. I'm putting it as FS, that is separate financial statements. And there is going to be another standard also which will trigger, and that is called IND AS 110, that is called consolidated financial statements. Wow. So when you say the answer is a yes, there are going to be three standards which will trigger in terms of step 3. Now watch this carefully. IND AS 103 is going to, trigger only once in the lifetime of this transaction. It is only going to trigger on the date of acquisition, not every year. It's a one-time application. So IND AS 103 in this particular case is a standard which you can say will trigger only once. This will trigger, you can say, only once in this particular case, and that is on the date of acquisition, DOA. So this standard will trigger only once in this particular deal on the date of acquisition. But IND AS 27 and IND AS 110 is going to trigger year by year. Because when A gets a control over the business of B, then A will be responsible to make two sets of financial statements. One is, you can say, his standalone financial statements, but we're not going to call it as a standalone financial statements. We're going to call it as a separate financial statements. And he's also going to make a group results as well, and he's going to make a consolidated financial statements as well. So these two standards are going to trigger every year end. So they will trigger every year end. So these standards will trigger on every year end. You will be required to make a separate financials, and you would also be required to make a consolidated financials as well. Now comes the agenda. When you say no in this particular case, the control is not acquired. In this particular case, you need to now apply a certain sequence of questions. When you say that the answer is a no, you need to apply certain sequence of inputs now. If I did not get a control, did I get a joint control? If you say not a joint control, did I get a significant influence? If not a significant influence, was I just a passive investor? And these questions need to be put across in a sequence. So you are going to put across a question that if you did not get a control, maybe you got a joint control. And if not a joint control, maybe you got a significant influence. So maybe you've got a significant influence. And if not a significant influence, maybe you are just a passive investor. Maybe you're just a passive investor in this particular case. And these questions need to be put across in a sequence. That did you get a control? If no. Joint control? If no. A significant influence? If no. Then you're a passive investor. Now, if you say that you've got a joint control, then in this particular case, there are two standards which would apply. Here again, the company is required to make two sets of financial statements every year. IND AS 103, of course, will not trigger in these three cases. IND AS 103 is going to trigger only if you get a control. So in this case, the standard which will trigger every year is IND AS 27, which is separate financial statements. And there is going to be IND AS, you can say 111, which talks about joint arrangements. It is called JA, that is called joint arrangements. So this is called joint arrangements. So basically, you can say that you would be required to make a separate financials and a consolidated financials year by year. So this standard is going to trigger every year. So here again, we can just make a mention that these standards will also be triggering, you can say, trigger every year end. This will also trigger at every year end. You will be required to make two set of financial statements. And if you say no in this particular case, that there is no joint control but a significant influence in this particular case, then you can say there are again two standards which will trigger. So one standard is going to be in this 27 again, which is a separate financial, because then also he will be required to make two financial statements year by year. So he is going to apply Ind AS 27, which is separate financial statements, and he will apply Ind AS 28, which I'm not giving the full term, but it is basically accounting for investments in associate in joint venture. So this is basically dealing with the concept of associates and joint ventures. I'm putting it as associates and JVs. And this particular standard is also going to trigger every year itself. These standards will also be triggering every year itself. So the list of these standards which are going to get covered under consolidation is huge in nature. And finally, when you say no, there is not even a significant influence, but there is a passive investment, then in this particular case, you are required to apply Ind AS 109, which is basically financial instruments. And I think it's worth important to tell you at this particular stage. And that is that when you're looking at the case of a passive investment, it is unrelated party. When you say there is a control, when you say there is a joint control, or you say there is a significant influence, in all these cases, it's a related party investments. And in financial instruments, I've already given you the inputs that when you are saying it's a related party transactions, then Ind AS 109 does not apply. Ind AS 27 applies. So it's also important to tell you that when there is a control or there is a joint control or there is a significant influence, this is called a related party. And when it is a related party, in this particular case, I've already given you clearly that Ind AS 109 is not applicable. So when you say that it is a passive investor, this is, we can say, not a related party. So when you say this is supposed to be a passive investment, it is not a related party, and 109 on financial instruments is going to trigger in this particular case. I know, friends, what's the feeling at this particular stage? You must be wondering, first class of consolidation with so much of plethora of permutations and combination. It's not difficult, but let me tell you one thing. Just like financial instruments, consolidation is a very, very important standard in the exam. Just like, if you cannot imagine a paper in the exam without a financial instruments, you cannot imagine a paper without a consolidated financials as well. So this is like the pillars in terms of the financial reporting paper. Let me now just quickly do a little consolidation of things, because I've given you the approach of the standard, because we need to be very clear that when you approach a particular standard, which permutations and combinations, which standard is going to trigger in this case. So let's quickly consolidate the picture to you in terms of the three-step model. But let me still ask you at this stage, are we all absolutely clear with the chain of thought in terms of the three-step model? Yes or no? Let's get your inputs at this stage. Are we fairly clear? That's wonderful indeed. Superb. So as I now quickly take a recap, as I'm going to put questions to myself, you can start answering them in your mind as well, so that we stand at a very common chain. Did I teach you anything since morning? No. I have just given you the inputs in terms of standards which would trigger at this stage. I have not given you anything technical so far. I've just given you the approach of the standard. So I started with a journey that if A approaches B to acquire something, you've got three focus points. The three-step model is focusing on a three-step points. What did you acquire is a focus one. And then if you say it is a group of assets, C, the focus, is it a business or not? And the third focus is that did you get a control or not? So one is individual or group. Second is the group a business? And the third is, did you get a control or not? So when A acquires something from B, you say, is it individual asset or a group of assets? If it is individual assets, then 16, 40, 38, depending upon tangible, intangible items would apply. You go to the step number two, that if it is a group of assets, you apply the principles of 103 and understand it's a business or not. If it is not a business, then you go to the valuer, tell him that you paid a consolidated amount. Please segregate on the ratio of relative fair value. Now I'm going to do a question on this area with you. I'm going to do a question on this area with you. And if you say, yes, it is a business, then you've got combinations to see, did we get a control or not? And in terms of the control, if you say, yes, three standards apply. If you say no, joint control, two standards apply. Sovereign influence, two standards apply. And passive investor, just one. So it's not that difficult that if it is a control 103 once, then 27 and 110 every year. Joint control 111, 27. Sovereign influence 27, 28. And a passive investor 109. So now you can see that which standards are we looking at. We've got a chain in terms of standard to study. We need to start a chain with 103. Then we need to go to 110. Then we are going to go to 111. And we're going to go to index 28. And of course, in between, we'll do the discussions on 27 as well. So 1, 2, 3, 4, 5. So we've got 5 standards to go. So we're going to spend 5 classes on Index 103, including today. And then we are going to spend time on Index 110. Then we're going to spend time on Index 111 and Index 28 as well. And that's how the entire consolidation standards chain is going to be done. Superb. So I think let's start the journey now. First of all, elaborating. I'm left with this part. So what I'm going to do now, let me tell you what is my movement further so that the sync is created. I'm going to first of all discuss this area in step 2, that it's not a business, but a group is acquired. Then I'm going to work upon the area, I'm going to work upon this area, that is concentration and the 3-element test. So I've got 2 agendas or discussions before we start with 103. I'm going to first of all do the discussions, group of assets, which is not a business. And then I'm going to teach you how do you identify that it's a business or not. Because there is a detailed input in the study material with examples and with illustrations illustrating the application of these 3 tests as well. So let me start first of all and take you to the study material to begin with. So there is a very interesting question which is given in the study material, illustration number 1. So I'm looking at the illustration 1. I hope that is visible indeed. So I hope the visibility is good to go. We can see the illustration, right? Okay, so let me, I guess, start with the inputs now at this particular stage. Let's read. Great. It says an entity acquires an equipment and a patent. So one thing is very clear. Is it individual asset or is it a group of asset? It is a group of assets. You've acquired an equipment and a patent, so which clearly indicates that it is a group of assets. Now, everything depends upon whether it is a business or not. Then he says, in exchange for 1,000 crores cash and a land, the fair value of the land is 400 crores and the carrying value is 100 crores. The fair values of the Equipment and the patents are 500 and 1500 crores respectively. Now he says that you acquired equipment and a payment in exchange for cash and land. So he paid a cash which is to the extent of 1000 crores, and the land book value, fair value is given. And he's also given you the fair value of what he acquired. This is just reminding me the principles in terms of Index 16. That when a company, acquires an asset by way of exchange, then what is the cost of acquisitions of the asset acquired? Is it equal to the book value of the asset given, or is it equal to the fair value of the asset given, or is it the fair value of the asset acquired? We'll come to that. Then he says the equipment and the patent relate to the product just recently commercialized and the developed market is developing. Assume the entity incurred no transaction cost. For ease of convenience, the tax consequences on the gain also ignored. How would the transaction be accounted for? Now, the first thing what you need to do in this particular question is to make an analysis that is this group of assets a business or not. I am not given any inputs in the question with the help of which I would be able to evaluate per se, nor I've given you any inputs at this stage. How do you evaluate? But let's assume that it's not a business. But we'll see that later. We'll revisit on that part. It says, as per the para number 2B, the standard does not apply to the acquisition of an asset or to a group of asset that does not constitute a business. In these cases, the acquirer shall identify and recognize the individual assets, blah, blah, blah. I am just coming to the inputs directly on the answer. Now, in this particular case, what I need to do, if I reach a conclusion that it is not a business, so one thing is very clear that I paid a consolidated consideration in terms of acquiring these two group of assets. I have basically acquired an equipment as well as a plant, and I need to get what is the value. Now, let's, I think, read this once again. I'm just taking you out here. The cost of the asset acquisition is determined on the basis of fair value of the assets given. Unless the fair value of the asset received is more reliably determinable. In the given case, the fair value measurement of land appears more reliable than the fair value of equipment patent. Therefore, the cost of acquisition is 1400 crores. So let's first get one thing clear. What I'm telling you at this stage is not Index 103, it is Index 16. What is the guidance given in Index 16 as far as an exchange transaction is concerned? When you acquire assets on an exchange, you need to understand, do we consider the fair value of what I gave? Or do I consider the fair value of what I received? And we always prefer to consider the fair value of what is given. Patents and the equipment is also given. But it is always preferred to consider that the cost of acquisition is what you give. And what you give is supposed to be the land and the cash. So the company paid a total of 1000 crores of cash and a land with a fair value of 400 crores. So you can say the consolidated consideration which is paid is to the extent of 1400 crores. So now the question rises, how would I split that 1400 crores? The fair value of the equipment and the patent. So what we're going to do in this particular case, the fair value of the consideration is allocated on the basis of relative estimated fair value. Now, I'm yet to explain you the concept of what is a relative fair value, which I'll do very shortly. So in this particular case, the relative fair value in this case is 500 and 1000 crores. We can say we can divide this in the ratio of 1:2. So when you go to divide this in the ratio of 1:2, so you will get the value 467 crores for the equipment and 933 crores for the patent. So this is the ratio of, you can say, the relative fair value in which the total consideration is split. So, but what is the relative fair value? Relative fair value is a very interesting concept. Watch this carefully now. In the same example, let me tell you what is the concept of relative fair value. Now, I am given as far as the equipment and the patent is concerned. The equipment is worth 500 crores and the patent is worth 1000 crores. There are two cases. Number one, the life of the patent and equipment is same. So I'm looking at the case number one, then the life is supposed to be same. If the life of both of them is same, there is no problem. You can take the ratio 1:2. But let's consider that the life of these assets is supposed to be different. If the life of these assets is different, let's assume that equipment is got a life. I'm just assuming that let's say the equipment has got a life of 5 years and the patent has got a life of let's say 10 years. So if they've got unequal life, then my concept of relative fair value will trigger. So what I will do, 500 will be taken as 500 only, but 1000 with a life of 10 is as good as 2000 with a life of 5. So how do you get that? So when you say 1000 with a life of 10 is 10,000, let that 10,000 be 10,000. So what if the life is 5, it becomes 2000. This is like equivalent production. This is like equivalent production. That in this particular case, we are saying 1000 with a life of 10 is 10,000. The product remains the same. If the life is 5, then this is 2000. This is called the concept of relative fair values in this case. So the standard requires you not to allocate the consideration simply in the fair value ratio. It requires you to allocate this in the ratio of relative fair value. So when you see that the life is equal, you can do it in the ratio of fair value. But if the life is unequal, you need to first bring them to a common life. That 1000 which has got a life of 10 years is as good as 2000 with a life of 5 years. So in this particular case, the ratio will become 500 is to 2000. The relative ratio is going to be 1:4. So this is the allocation technique when a company acquires a group of asset which is not a business and you paid a consolidated consideration. Trust me, this can be a brilliant question when the examiner is testing your knowledge in terms of Ind AS 16 exchange transaction along with the application of Ind AS 103. Superb. Okay, so that answers, I think, one inputs now at this stage. Let me just come back on the three-step model which I gave you. So I have now given you the split of this. If you want, you can, for your reference later, you can just make a mention. You can refer to illustration number 1 of the study material in this particular case. So this is giving you a mapping in terms of when a group of asset is acquired which is not a business, how is the consolidated consideration split in the ratio of relative fair value. Now comes my second agenda, and that is how do I decide a group of asset is supposed to be a business or not? Now, friends, the things are going to get technical because what I'm going to give you now, you need to appreciate this bit. So far so good. The journey has not been very technical indeed, but now suddenly you see the level is going to suddenly increase. But you'll understand if you hear this carefully, analyze this carefully. Let's now begin with the elements of the concentration test. So let me first introduce you to the two tests which are given in 103. Now hear me very carefully, very carefully. I'm now going to introduce you to the concept of how do we decide whether it is a business or not. So I need to decide, how do we decide it's a business or not? So please watch this very carefully. Couple of years back, I would say it's been almost, I think maybe at least 4 to 5 years back, there was a major amendment in terms of Ind AS 103 on the concept of identifying the business. Now, in this particular case, the standard setters actually realized that there was a lot of complicated guidance in terms of telling the industry whether a group of asset is a business or not. So they wanted to basically, ease out situations for certain industry. Because sometimes the transactions are very straightforward, and telling the industry to apply complicated standards in terms of identifying whether it's a business or not can be quite big challenge as well. So in this particular case, what they did, they introduced two kinds of test. The standard introduced two kinds of test. One is called a concentration test, and the other is the IPO, or the three element test. So one is called a concentration test, and the other one is what I call a three element test, or we can call it as an IPO test, that is input process output test, IPO test. Now, as far as the concentration test is concerned, it is not mandatory. It is not mandatory. It is called optional in nature. This is not mandatory. It is completely optional in nature. Now, what do we mean by that it is optional? So, a company A acquires a group of assets of B. I'll tell company A, you want to apply a concentration test? It says no. I'll say then you apply the IPO test. But the company says, yes, I'm applying a concentration test. And if it passes, it's not a business. And you cannot apply the IPO test. Hear me carefully. Once the company is put across a question, do you want to apply the concentration test? They say no. I'll say then apply the mandatory IPO test. If they say a yes, I'll say, okay, if you pass this test, it is not a business, but then you cannot apply the IPO test. And if you fail, then you need to apply the IPO test also. So the procedure is very simple, what they give. So in this particular case, there are two courses of actions the company can do. So in this particular case, the company says, yes, I want to apply. The company says, yes, I want to apply. Or the company says, no, I don't want to apply. I don't want to apply. So it is a complete choice on the part of the company. They want to apply this test or not. If they say, yes, I want to apply the test, in that particular case, once the test is conducted, they pass or they fail the test. So once you choose to apply the test, you may pass or you may fail the test. If you pass the test, then it is not a business. The conclusion is made that it is not a business, and IPO test cannot be applied. Then IPO test cannot be applied in this particular case. So once you pass the concentration test, then the IPO test can be applied. You've reached a conclusion that it's not a business. But if you fail this particular test, or if you say that you do not want to apply this test, then this test is mandatory. Then this test becomes mandatory in nature. This is what you need to keep in your back of the mind. So when you're looking in terms of evaluating the test which is given in 103, there are three permutations and combinations if you put it across. The permutation combination one, you applied a concentration test and you pass. Not a business, no further testing allowed. Second combination, you said, I'm not applying this test, then you go to the three element test. Third combination, you applied and you fail, you go to the three combination test. So you choose not to apply, IPO. You apply and fail, IPO. And you apply and pass. Business is not there, IPO test not allowed. I hope I'm clear with the picture, the three combinations indeed. Okay. Now, after understanding that which test is optional and which test is mandatory, we now need to understand what is a concentration test. I will explain the concentration test in two phases to you. I will first give you an explanation which is simplified and anybody can logically understand. Then I'll take you to the second phase of understanding where we need to understand in a more technical detail because there is an illustration given in the study material which is of course taken a little more complicated inputs in that. So I'll explain this in two parts, one a very simplified manner and then I'll give you a little more complicated inputs as well. Let's see. So let's first of all talk in terms of the concentration test. Let's talk in terms of the concentration test. And since it is optional, many times we call it as optional concentration test because it is purely optional in nature. Let's take a very simple example to illustrate this concept. So as I said, let's understand this in two phases. Let's first consider a simple part, then we'll take more complications. So first, let's take a simple example. And then I will take a little more complicated example. I will take a little more complicated example, which would be after the simple example is understood. Let's assume that a company A acquired, let's say, three assets XYZ. So let's say company A approaches company B and it acquires, and let's say it acquires three assets XYZ. So let's say he acquires three assets XYZ, and let's say the fair value of this asset is, this is, let's say, to the extent of 920 crores. This is, let's say, to the extent of 30 crores. And let's say this is to the extent of 20 crores. I'm just taking some arbitrary figures that A approaches B and he acquires a group of asset XYZ. You are now testing, is this group of assets a business or not? Now mind the words carefully. If this clicks, it clicks in a second. In this case, let's say the purchase consideration paid is to the extent of 1,000 crores. Let's say the purchase consideration paid is to the extent of 1,000 crores. Now I'm going to say a sentence. If it clicks, evaluate this. Can I say the purchase consideration is concentrated in terms of asset X? I said the consideration is concentrated in terms of asset X. 95% of the consideration is concentrated in terms of A. You can see that on a mathematical front. 92%, sorry. So we can say 92%. Rather, I should have taken this 950 to match this. So this is going to be 950 crores. So we can say that if you look at on a mathematical level, 95% of what you paid is paid towards A. So I paid a total consideration of 1,000 crores for which I paid 95% only towards A. So the standard setters had a belief that if you're paying 95% towards a single asset, if 95% is paid almost towards a single asset, it cannot be a business. Now the question is that what is the cutoff factor? What is the percentage at which I would say that if you're paying this percentage towards a single asset, it is not supposed to be an asset? The standard says that if you are paying a substantial percentage. Now what is a substantial percentage is nowhere defined in the standard. But generally, for understanding point of view, we believe that when you use the word substantial, it should be 90% at least. So if you pay 90 or more than 90% of the consideration towards a single asset or towards similar group of assets, mind the words what I'm saying. So when you land up paying 90 or more than 90% of the consideration towards a single asset or towards similar assets, then we can say it's not a business. So in this particular case, the standard is given the parameter that this percentage is something which should be substantial. Now, what is substantial is not defined in the standard. What is substantial is not defined in the standard, but for understanding point of view. I said only for the understanding point of view. From the understanding point of view, we can generally say it is 90% or more. If 90% or more than 90% of the consideration is concentrated in a single or a similar group of assets, it's not a business. That was simple. I hope, friends, you've got the basic flair in terms of this, right? Got the basic understanding in terms of this, that a company is looking at. The company is looking at, is your consideration concentrated? That's the name called concentration test. Is the consideration concentrated in a single, or you can say similar group of assets? Correct. Now it's time to give you a little complicated example. This was a simple example just to illustrate the deeper meaning, or why do they call it a concentration test. Now the complicated example is given in the study material. So let's, I think, have a look at that question in the study mat. So I'm now going to take you to the study material, and we're going to look at a wonderful question which is there in the study mat. So let's have a look at this particular example. Now watch this carefully, because I am going to give you a lot of mathematical inputs in this case. So we are going to do a lot of mathematical inputs in this particular case. So first, let's read the inputs out here, and then we'll analyze this further. It says A has got a 20% interest in B, and subsequently A further acquires a 50% stake in B by paying 300 crores. Now friends, you need to watch the maths very carefully, because if this clicks, it clicks. What I'm going to do is basic common sense maths. And sometimes what is common is most uncommon in life. So I'm just going to give you some basic maths. Please watch this carefully. I am saying that the company A, it says, holds a 20% interest in B. He's already got a 20% interest in B. This is what we technically call it as a PHI. That is called a previously held interest. So please hear my terms very carefully. The next 10-15 minutes are going to be very, very crucial. You get the concept or you don't get the concept, the chances highly likely you'll get it. So it says A holds a 20% interest in B. I would say this is called a PHI, previously held interest. And then it says A further acquires a 50% stake, and I would say this is the consideration. This is what is acquired. We can say this is the consideration transferred today. So when he acquired a 50% stake today, there is a consideration transferred today. And 20% he already had, which means 20 plus 50 makes it 70. So there is another 30% which is not with A. Which is not with A. That 30% which is not with A is called NCI. It's called a non-controlling interest, because when A gets a 70% stake in B, I would say he gets a control. And the remaining 30% is there with somebody who doesn't have a control, and that's called a non-controlling interest. So we're going to call this as NCI. Now, one thing is very clear, that if you add up the sum total of these three, then it becomes 100%. Because 20% is what he paid earlier, 50% he paid today, and the remaining 30% is with somebody else. So what you're going to do at the first instance is, number one, you are going to add the three elements. Step number one. The step number one is you got to add the three elements in this case. You got to add the consideration trustword plus the PHI plus the NCI so that you are able to reach 100% percentage at this stage. Now, another thing which you need to be careful on is that 20% PHI will not be taken at the amount which you paid historically. You got to consider 20% as the fair value today. The consideration is what is paid today. The 20% is not what you paid, yesterday, but you got to consider the fair value. Even the NCI will be taken at a fair value so that I am able to get the valuation of the business of B in terms of 100%. Because if you add up the 20% fair value today is so and so, 50% is so and so, 30% is so and so, you are going to get the fair value of the entire business or the net assets. So this will indirectly give you, you can say, the fair value of the net assets in this case. Let's read further. It says the fair value of the assets acquired and the liabilities assumed are given. Now, there is another interesting input. This is what you do in step one. Then you need to go to step number two. We need to understand one very important thing. What is the consideration paid and what is paid for, have you largely paid for a single asset? Now, please hear me carefully on a mathematical front. I'm saying that this is what you paid for the net assets. When you add these three elements, you will get what you paid for the net assets. And you're looking at that, is there any single asset for which you paid? So you need to be careful that on one hand, you've got the consideration paid for the net assets. And you're saying that what did you pay for a single asset? So there is a need to convert this. There is a need to convert this from a net assets to what is paid for the assets. Get this very clear. In step number two, what you're going to do, you will translate what is paid for the net assets to what is paid for the assets. How would I do that? I will simply add the amount of liabilities to this and I am going to get what is paid for the assets. So if I paid, let's say, an X amount for the net assets, how much will you pay for the assets? Add the amount of liability, you're going to get what is paid for the assets. So it says the fair value of the assets acquired and the liabilities are given, and you are given in this particular case that there is supposed to be a financial liability and there is a deferred tax liability, and the deferred tax liability is supposed to be what we call a notional liability. Because a DTA or a DTL is not an actual asset liability, but it is notional in nature. Now, I think let's first go down. So let me calculate what is paid for 50%, 300 crores. So this is paid 300 crores for 50%. Then he says the fair value of the previously held interest, what I called PHI, is 80 crores. How do you get that 80 crores in this particular case? Since I am given out here the fair value of the entity B is 400 crores. The full value of the entity B is 400 crores. So 30% is NCI. That makes it 120 crores. And 20% is the PHI. That makes it 80 crores. So what we have done, we know the fair value of this portion, that is 300 crores. We need to get the fair value of this portion. We need to get a fair value of this portion. So we've added that 120 and 80. So let me put this once again out here. What is this 300? 300 is the fair value of that 50% acquired. When you acquired a 50% stake, you paid 300 crores. I need what is the fair value today for that 20%. The business is valued at 400 crores. So 400 crores into 20% is 80. and 30% is with the NCI. So you can say 400 into 30% is supposed to be 120. So what is this 500 crores? This 500 crores is step number one, which I said, what is paid for the net assets of the company. No worry, we'll consolidate again. So in this particular case, in terms of step one, you need to calculate what is paid for the net assets. Add the consideration, add the PHI, add the NCI, you get what is the amount paid for the net assets. And then you can see that we are given the fair value of the liability excluding DTL, that is supposed to be 800 crores. Now, when you are going to add the liability, you are only going to add the actual liabilities. You are not going to add any notional liabilities in this case. Because I need to consider what is paid for the net assets and then convert it into what is paid for the assets. So we will add only what is the actual liability. DTL is a notional liability, so we're not going to add it. So to this 500 crores, if you add 800 crores, this works out at 1300 crores. So this is what you can say is the amount paid for the assets. This is the amount paid for the assets. So in step number one, you calculated what is paid for the net assets. In step number two, you said, okay, let me calculate what is paid for the assets. But now the interesting part also is that as a part of the assets, the company has acquired a cash as well. How much will you pay for a 200 crores of cash? You'll pay the same 200 crores. If you acquire somebody's business and you are getting a cash worth 200 crores, I'll pay you 200 crores itself. So that's like, a transaction. You're getting 200 crores, you pay 200 crores. So I think it is illogical to include that. So what we're going to do in this particular case, when you're converting the net assets to assets, we will also reduce the amount of cash and cash equivalents. Because I need to consider what is paid for the assets other than cash. So I will be converting what is paid for the net assets and then convert it into what is paid for the assets. I want to see what is paid for the assets other than cash. So reduce the amount what is paid for the cash. I pay 200 crores for the cash. So in this particular case, the cash equivalent is 200 crores. So 500 plus 800 is 1300 crores. Minus that 200 crores, you get 1100 crores. This is the value of gross assets acquired. In simple words, we are translating what is paid for the net assets into what is paid for the assets other than cash. So the company basically paid, you can say 1100 for all the assets other than cash. Now comes the step number three. And in terms of the step number three, we will now consider that, okay, your company paid a total of 1100 crores. Your company paid 1100 crores for the assets other than cash. You paid 1100 crores for the assets other than the cash. Tell me now, which is that asset which is got the highest fair value? See whatever assets you have acquired, which asset has got the highest value. If you notice, the company purchased a building which is 1000 crores. So we can say the asset which has got the maximum value is building. So express the fair value of the building as a percentage of this 1100. So when you consider 1000 by 1100, it works out at approximately 91%. So we can say 91% of the consideration is concentrated in the building. 91% is concentrated in a single asset, which means this cannot be a business. So we can see out here, when you look at the calculations, 91%. So in our view, we have considered 91% value as substantial to conclude that the above transaction is an asset acquisition. So since we said the standard does not give you any guidance in terms of what should be the percentage, but if it is generally more than 90, 90 or more than 90, if 90 or more than 90% consideration paid is concentrated towards a single asset, you cannot say it's a business. Because when you're acquiring a business, you need to acquire something more. You're almost paying for a single asset, and paying some nominal amount for other assets cannot be a business. Did you get the clarity in terms of things? I know this is difficult. So let me just consolidate this inputs once again. We are just going to do the consolidation once again on this area. I'm just going to quickly consolidate this, but let me first ask you, friends, are we pretty clear in terms of the application of the concentration test three-step model? Today we've got so many three-step models coming in. We've got the first one introduced, then we got another three-step model on the concentration test. Trust me, even in terms of the IPO test also, I'm going to give you a three-step model. Today we're going to get three-step model. One is on the combinations of standard, one is on the concentration test, and one is on the IPO test as well. So far so clear, friends? Are we so far so clear at this stage? Say yes or no. Let's get the inputs. I know it's a little complicated affairs, but I guess it is still interesting. That's wonderful indeed. So let me come to a little more detail now on the concentration test. So let me give you the inputs in terms of the concentration test. This is a beautiful illustration which is given in the study mat, which makes a walkthrough in terms of the concentration test. Now, as I give you the steps, look at the consolidation, how the movements are taking place in this particular case. Just look at the movements very carefully indeed. So we're going to consider a three-step model in this case as well. This is on the concentration test. So one thing is very clear, that you don't need to remember the steps. You need to go on a logical levels. Now, what is the concept? First of all, in terms of step number one, I need to calculate what is called the amount which is paid for net assets. I'll put it like this, that the amount which is paid for the net assets. And I need to calculate the amount which is paid for the net assets, that is 100%. I want to calculate what is paid 100%. So get this mathematically clear. As A Limited, I may not acquire 100% assets of the company. I may acquire only a percentage. Something I might have acquired earlier, something I acquired today, and something is not there with me, it's there with the NCI. So the amount which is paid for the net assets, that is 100%, is comprising of, you can say, three elements. On a mathematical level, you need to be clear that this comprises of three elements. One is what we call PHI, that is called a previously held interest. That is called a previously held interest. Something which you acquired earlier in this case. And then there is something which you acquired today, that is called a consideration transfer. And something which you don't own it, and it is called an NCI, that is called a non-controlling interest. So your step number one would be in terms of adding up these three elements so that we can get what is paid for 100%. Now, in my example, what is the PHI 20%? So in the example which we just did in the study material, what is paid for the consideration? 50%. And what is there with the outsider, which is a non-controlling, is 30. So when you add 20 plus 50 plus 30, this comes to a total of 100%. But what you need to keep in mind is also another important input, that when you consider these three elements, you need to consider the fair value. So what is important in this particular case is that we need to consider we need to consider the fair values. So we need to consider the fair values in this particular case. So I think let me also mathematically keep writing down the inputs as well. So if you notice in this particular example, the business valuation was 400 crores and 20% is the fair value today, 80 crores. The consideration transferred is already given to me. That was, I guess, to the extent of 300 crores. And if you consider the NCI, the business valuation is 400 crores and 30%, that is 120 crores, is supposed to be the NCI. So we've taken the fair value of the PHI, we've taken the fair value of the NCI, and what you paid today, of course, is the fair value. So when you add 80 plus 300 plus 120, this total works out at 500 crores. So I think now you can mathematically very clearly see that when you're calculating the step number one, your focus in terms of the step number one becomes very clear indeed. And in this particular case, what you've done, you've added those percentages and you get what is supposed to be. What is supposed to be, you can say the sum total of what is paid for 100%. Then let's go to the step number two. So then we go to the step number two, and now the objective is, you know what is paid for the 100% net assets. I need to translate this in terms of what is paid for the assets other than cash. So we need to see that what is paid. We need to see what is paid for assets. From a net assets, we are converting this, what is paid for the assets other than cash. So we need to calculate what is paid for the net assets other than cash and cash equivalents. Because we paid a certain money for the entire business, net assets. Now we need to translate this in terms of what is paid for just the assets, that also without the cash. So in this particular case, we pick up the input. So what is paid for net assets that you've already calculated is to the tune of 500 crores. So in order to translate this in terms of what is paid for the assets, what do you need to do? You need to add back the liabilities. You need to add back the liabilities, and the liabilities to be added is supposed to be the actual liabilities in this case. We're not going to add back the liabilities which are notional in nature. So in this particular case, leave the notional liability. And the only notional liability in the balance sheet of the company is supposed to be a DTL. There is no other notional liability in the balance sheet of the company. So in this particular case, we will exclude the deferred tax liability. And the liability in this particular case was 800 crores. And since we need other than cash and cash equivalents, what we do, we reduce the amount of cash and cash equivalents. And the cash and cash equivalents is to the extent of 200 crores. With this, you are able to translate. With this, you are able to translate what is paid for the assets other than cash and cash equivalents. So this will give you the inputs in terms of what is the amount paid, what is the amount paid for assets only. What is paid for the assets only other than cash and cash equivalents. So what is paid for the assets only other than cash and cash equivalents, and that works out at 1100 crores. That is what we're going to do in terms of step number two. And then in terms of step three, you need to identify that single asset with the largest fair value. So let's put the step number three. So what do we need to do in step number three is identify the asset. Identify the asset, or we can say, let's put it like this, identify the asset, or we can say similar group of assets, which we'll see later. or I want to put it out here, that we will see that what is the asset or the similar group of assets with the largest fair value, with the highest fair value. So identify in the deal that which asset or a similar group of asset is got the highest fair value. In this case, it was building. So in this particular question, it was supposed to be a building which has got a value of 1000 crores. Then what you need to do in this particular case, express this as a percentage. Express this as a percentage of step number 2. You need to express this as a percentage of the step number 2. So when you express this as a percentage of the step number 2, this is 1000 crores divided by 1100 crores. And when you calculate the percentage, it came to 91% approximately. So with this inputs in hand, you will be able to do the evaluation that whether it is substantial or not. So once you get this 91%, so we can say that there are two possibilities. We can say, let's not put this, 90 and all, but let's put it that it is substantial. It is either substantial, or we can say it is not substantial. If it is supposed to be substantial, then we can say it is not a business. As we said, generally, if it is 90%, less than 90 or more than 90, we will say that it is not a business, it is substantial. Then we say it is not a business, and of course, IPO test cannot apply. In this particular case, the IPO test cannot apply in this particular case. But if you say it is not substantial, you go to the IPO test in this particular case. If the percentage is not substantial, you go to the IPO test. I hope, friends, the chain in terms of the concentration test gets very clear. So I guess we have covered the first test, which is called the IPO test, the concentration test, where the elements learned are that the concentration test is not mandatory. It is optional in nature. And when you apply the concentration test, you need to apply this in a simple 3-step model. First, you get what is paid as a whole, 100%. Convert that in terms of what is paid for the assets, and that also other than cash. And then see that if a particular asset, the consideration is concentrated or not. If yes, it is not a business. It is an asset acquisition. And in this particular case, you cannot apply the IPO test. But in a situation where you conclude that yes, it is substantial, it is not substantial, then you need to mandatorily go to the IPO test as well. Okay, so this part is done. So I have given you the inputs in terms of the concentration test as well. Now let me just come back on the chain and tell you what is more pending in terms of my initial discussions as well. But before we go further, friends, let's, I think, get a little score of comfort zones at this stage. So what is your comfort zone on a scale of 10? Because generally I'm in a habit of asking these questions to you. So what is your comfort zone on a scale of 10 regarding the concepts covered so far in terms of the 3-step model, approach to the standard, and the concentration test? 10 out of 10, that's wonderful. 9 out of 10, that's wonderful indeed. Superb. So now let's see what is the pending part. Step 1 fully covered. And in terms of step number 2, I've already covered this part when it was a group of assets, not a business. I've covered the concentration test. Now we need to cover the 3-element test. And then the journey comes in terms of step 3. This is going to be in different standard. Now we need to go to the next test on a business, and that is called the IPO test. So what I'm going to do, I'm just going to give you some kind of a base before we give you a break. But I'm going to first make some base at this particular stage and then give you a break, and then we're going to work heavily upon the IPO test. Now, let's give you There is a very interesting chart which is given in the study material, and I want to explain this chart. So we're going to spend some time understanding this particular chart. Brilliant chart indeed. So we're looking at this particular chart, which is a summary chart given in the study material, which explains the IPO test. Wow. But I think before we understand this particular chart, I need to understand first of all, what is this IPNO? And I'm going to translate this also into a three-step model. Sir, everywhere you're always creating a three-step model. Yes, and that's the interesting part. So, when you are going to revise things as well, the chain is going to be very clear in your mind. Okay, if this is the case, this is the steps. Easy to remember, easy to recall as well. Now, first, let's understand what is this IPO. So let's give you a little inputs in terms of what is I, that stands for input. And there is P, that stands for process. And then there is O, which stands for output. So let's first of all basically understand what is an input, what is a process, and what is an output. Let's take a very simple example. Let's consider I am manufacturing a car. So if I'm manufacturing a car, the car is my output. And what is my input? I would say, the steel, for example, or could be other items as well. So I would say the input is the steel and the output is the car. The conversion of the steel, that is the input in terms of the car, that is the output, would require certain processes. And that is what is called a process. So every time a company is producing something, there will be some input which is required and they will translate that into an output. But this entire translation process will require an output. For example, if I'm looking at companies making Coke, company making Pepsi, so I would say it's like input is, let's say the water. I'm not getting into technical details, so don't tell me there is going to be carbon dioxide as well. We're not technical people. We're just considering water. And then we can say that the Coke and Pepsi is the output. So you are translating that input into output, and that is called a process. So unless and until in a company you acquire a process, it can never be a business. So let me tell you that if somebody were to tell me that what are the most essential elements of a business, I would say input, of course, is an essential element. Process, very essential. Output is not an essential element. Because output basically means that the company is already producing something and it is already selling something and generating a revenue as well. But there could be some startup companies as well, or companies which are still in the research phase and they may not be earning a revenue. And if they do not earn a revenue, there is no output. So the presence of the output will be seen in terms of whether the revenue is being generated or not. So if you see that the company is earning a revenue, it indicates the presence of output. When you say that the company is not earning a revenue, that means there is no output. And let me also tell you that when you look at the concept of a process, it could be generally, a kind of a formula which is used for the purpose of converting the inputs into output. Water is converted in terms of Coke and Pepsi with a certain kind of a formula, and that is a process. But the interesting part is the standard says that the process can also be an organized workforce as well. So there could be certain individuals or there could be, group of people who have the requisite knowledge and the skill. And they are the people who know how to convert that input in terms of output. So when you're looking in terms of the process does not necessarily only means that there is a formula for conversion. But when you're looking at a process, we are looking at the fact that there is some kind of an organized workforce as well. The employees are inputs also. The employees are processes also. But these employees, what we are talking of is not supposed to be, the administration staff. This is not the employees which is in the sales and department staff. These are the employees who are having the necessary skill and knowledge, the experience, who know the conversion process. So it is only those people will be considered as an organized workforce. So one thing is very clear, that when you look at the acquisition of a group of assets, whether the company has got a revenue today or not, whether they've got an output today or not, doesn't make a difference. But what is important is that there should definitely be an input and a process. So input, of course, would mean something like, if you're looking at a building, for example, or you're looking at a raw material, for example, and even employees, they will also be considered as input as well. So employees are input, but the organized workforce is supposed to be both input as well as a process. So in nutshell, if somebody tells me that what is the most important element in terms of the business out of these three, I would say process. If you do not acquire a process, you acquire just an input, it can never be a business. So input and process are the two important elements. Output is there or not doesn't make a difference. So this is one chain which you need to keep in the background. Now, let's, I think, have a look out here that we can see that every place we are either given go to A or go to B. So when you say you go to A, in this particular case, it is asset acquisition, A for asset. When you say B, it is supposed to be a business combination, B for business combination. So in this entire chart, when you reach a conclusion that go to A, that means it is asset acquisition. When it says go to B, it is a business combination. So when you say it is B, that means you are under the purview of the standard. It's a business. And if you say it is asset A, then it's an asset acquisition. Index 103 would not trigger. Now comes the inner parts of this particular chain, which I think I'm going to discuss after the break with you. I'm sure you must be feeling a little more heavy at this stage with the tremendous data given. But the first class in a topic is always pertaining to getting some good amount of inputs. This standard also, friends, I would earnestly request you that please make a cumulative revision of the standard, because financial instruments is one which was very long, almost took us 10 classes to finish. Even business combination is going to take us 5 classes, and then consolidations and those standards will also take a lot of classes. And it is, what is important is that as you keep moving ahead of the standard, you also need to get a binding in terms of the previous connect. So which I'll of course help you towards the end today also. I'll give you a little quick mind map of the concepts as well. But I think let's first take a break at this stage. Let's give you a 10-12 minutes break at this stage. Then I'm going to join you after the break. So enjoy your break, friends. We're going to join you after the break. Welcome back, friends. So, I hope you had a relaxation of your mind. So, now we are back to the second test in terms of identifying a business, and that is called the IPO test or the three element test, for which I've just given you very basic inputs in terms of what three elements are there, that there is input, there is process, and there is output. Now let's, I think, make a walkthrough in terms of this three element test, which I will again translate this into a three-step model. Now, as we're going to read the inputs, your mind will still asking you questions. So, example, don't worry, we've got some good case studies on that. I will be taking some few examples where we will illustrate the application of this IPO test as well. Just like we are done for the concentration test, no worries. But first, let's get the concept and then we will do examples as well. But let's first get the larger concept clear. So let me just come back to this particular chart. I would say this is like my step number one, where you say, did you acquire input and processes? As you can notice that the focus is not on the output. As I've already said, that out of the three elements of business, the process that is, sorry, the output, which is also the revenue, is not an important element. So in this particular case, your step number one is concentrating only, did you get an input and a process? If you say no, you did not get input and process, then in this particular case, it is undoubtedly an asset acquisition. But if you say yes, it is supposed to be an input and a process, then you need to go to the step number two. Then you need to go to the step number two. Now, in terms of the step number two, the focus is now going to be on the third element, that is output. Because once you've acquired the input and the process, the main focus now is on the output. And let me, I think, tell you at this stage, if the company has no output, the test is going to be a little more stringent in nature. And if they've got an output, the test is going to be less stringent in nature. So what the standard has done, if the entity, the acquiree, is not having a revenue, it's not having an output, then the test is a little more stringent to decide whether it's a business or not. But if there is an output, the test will get slightly less stringent. So what I would do in terms of step two, only identify whether the output is existing on the acquisition date or not. So either you get a yes or you get a no, and then I would, make it step three so that you can cover it out here only. I want to make it a three-step model. So let's keep the step number two very light as well, that you just need to see that the output is there or not. How would you identify the output is there or not? Your focus will be in terms of revenue. If the revenue is there, output is there. If the revenue is not there, then the output is not there. Now let's see the chain of thought when you say that there is an output. So when you get the answer yes, it says whether it is critical to the ability to continue producing output. Whether it is critical means you're looking at the process. We're looking at the process. We need to see that is the process critical in nature. So it says whether the process is critical for the ability to continue producing the outputs, and the inputs acquired include an organized workforce as well. I'll put it like two conditions. I'll put it like two conditions. I will put across a question number one, that is the process critical? Now you would say, how would I decide the process is critical in nature? Well, I guess there is a lot of guidance which is given in the standard, but of course we're not going to get into those kind of technical details. But you can definitely, with the language of the question, make an assessment whether the process is critical or not. That means without it, I cannot convert it into output. So the word critical, of course, will be interpreted that it is something which is necessary, very necessary in nature. And that is condition one. And the second condition is that as a part of the inputs, you must have acquired that organized workforce. Because as I said, the organized workforce is supposed to be a process who knows the process, who has the skill and the knowledge with which the input is going to be translated into output. So see, are both the elements there? If the answer is a yes, then it is undoubtedly a business. You just meet the two conditions. So when there is an output, you got to put two questions to yourself. Is the process critical? And did you acquire an organized workforce? You say a yes, you say it is a business. But if you say no to these two questions, then you need to further investigate. If you say no, I'll not say that it is an asset acquisition. I've got another chance as well, which means this is like, you can say, the option A, and this is like the option B. You need to meet any one of the two options. You need to meet any one of the options. So if the output is there, I'll say you've got two conditions in block A. You've got two conditions in block A. The process is critical, and condition number two, organized workforce is acquired. Otherwise, you go to the block B, whether the acquired processes is unique or scarce or cannot be replaced without significant cost, effort, or delay. Or just prove it to me that the process which you're talking of is something unique, something scarce. So if it is unique or it is scarce, or you cannot replace it without a significant cost, effort, or delay. So prove it to me that the process is something, very, 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 very critical, in the sense that it is something which is unique, or it is scarce, or it cannot be replaced without incurring a significant cost, effort, or a delay. If you say yes, it is something unique, scarce, it cannot be replaced without incurring a significant cost, effort, and delay. And if you say yes, it is a business. And if you say no, then it is an asset acquisition. Some moral of the story, when you're looking at whether the output is there or not. Now, when you say yes, the output is there, I would say you meet either two conditions or you meet one condition. I said you meet in terms of A, you meet two conditions or you meet one condition. So what is the two conditions? Prove it to me the process is critical. Prove it to me you acquired an organized workforce. Either you prove these two, or you prove me just one. The process is unique, it is scarce, it cannot be replaced without any significant cost, effort, or delay. Then I would say it's a business. Prove it, prove the two conditions or prove the one conditions. If you cannot prove the two or the one, then it is asset acquisition. Next focus. If you say no, there is no output. Now what it says, this yes is like an and. This yes is like an and. So if there is no output, the number of conditions will get stringent. As I said, the presence of the output means I'll be less stringent in evaluation. You meet any two or one condition. But if there is no output, I'm going to be more stringent in terms of deciding whether it's a business or not. So it says whether it is critical to the ability to the development of acquired inputs into output. So the first question is same, is it critical? And then it's and whether the inputs acquired includes both an organized workforce and other inputs the workforce could use to convert into output. So this is like condition number 2 and a condition number 3. So there are 3 conditions. So let's remember it easily. If you say that there is no output, if you say there is no output, you meet 2 or 1. If you say that, sorry, if there is output, if there is an output, you meet 2 or 1. If you say there is no output, you meet 3. You need 3 conditions. You need to prove that the process is critical, number 1. You need to prove you acquired organized workforce, number 2. You need to prove, number 3, you've acquired other inputs also, on which the organized workforce is going to work, and they're going to convert the input into output. So some other inputs should also have been acquired. And then once you reach the conclusion, yes, then in that particular case, if you say yes, it is supposed to be a business. But if you say no to any of these conditions, then it is an asset acquisition. We're going to convert this, of course, into a three-step writing as well. But let's first make a little walkthrough with you. We'll do case studies also. We'll apply these elements to the case study. But let's, I think, get the picture clear in terms of what we call the three-element test. So let's make a walkthrough. Then I'll write it down. My step number one is, did you get inputs and process? No output. If you say no, it's not a business asset acquisition. If you say a yes, you go to step two. In terms of step two, the focus is only the output is there or not. How would you identify the output? Revenue is there, output is there. Revenue is not there, output is not there. Then you go to the step number three. If you say that the output is there, you meet either two or you meet either one of the two conditions. The condition number one is the process is critical and organized workforce is required. And one of the conditions is the process is unique, scarce, cannot be replaced without significant effort, cost, or delay. You meet either two or you meet either one. It's a business, you fail, it's an asset acquisition. If you say there is no output, there are three conditions. The process is critical, one. Organized workforce is required, two. And you've acquired other inputs on which the organized workforce will work and convert that input into output. If yes, it's a business. If no, it is not a business. At least we got the chain of thought clear, right, friends? Then let me document this. Then we'll do case studies. I hope I am clear with the agenda. So let me, I think, put some notes now at this stage. Let me first pen this down, then we'll do some questions on this area with you. So I am looking at the IPO test, what I also called as a three-element test. The IPO test, or what is also called a three-element test. Now, in terms of the IPO or the three-element test, we will again apply a simple three-step model. We're going to simply apply a simple three-step model in this particular case. In terms of my step number one, in terms of the step number one, you just need to focus on, did we acquire? Did we acquire input and process? Did we acquire input and process? So underline input and process. And I think let me make it very clear at this stage. When I'm focusing in terms of input and process, we are not looking at output at this stage. We're not looking at output in step one. The focus is not on the output, but the focus is only on the input and the process. So the answer would be a yes or a no. So if the answer is a yes, I'll go to step number two. And if the answer is a no, then in this particular case, it is an asset acquisition. It is not a business acquisition. It is an asset acquisition outrightly. Then we go to the step number two. And in terms of the step number two, we just need to see, is the output present? Is the output, underline the word output, present on date of acquisition? I'm putting it as DOA, date of acquisition. So we need to see that the output is present or not. And how would you identify the presence of output? We can say the presence of revenue. The presence of revenue indicates output. The presence of revenue indicates output. If you have got revenue, that means there is output. If there is no revenue, that means there is no output. So here again, the answer would be a yes or a no. And if the answer is either a yes or the answer is either a no, in both cases, I will go to step number three. So focus in terms of step two is only to see the output is present or not. Makes it simple. Now let's go to the step number three to evaluate the two permutations and combinations. So we can say there are two permutation combinations in this case. So let's make a broader chart. So there are two cases which we can confront in this particular case. I'll put it as situation 1 and I'll put it as situation 2. So situation 1, output is there. Situation 1, the output is there, and situation 2, output is not there. The output is not there. So what you've seen in terms of step 2, you identify output is present or the output is not present. Now, as I've already said, that if the output is not there, more stringent, output is there, less stringent. So when the output is there, I would say that you need to meet either two conditions. You need to meet either two conditions or one condition. You need to meet either two conditions or one condition. So what are the two conditions and what is that one condition? The two condition is that the process is critical. So the first condition is that the process is critical. That's one. And the second condition in this case, so let's put a plus out here because you need to prove the second one, that we can say organized workforce is acquired. So in this case, organized workforce is acquired. So you should be able to evaluate that organized workforce in this case is acquired. And when you say that there is one condition, that one particular condition is the process is unique. The process is something which is unique, or we can say scarce, or we can say it cannot be replaced. It cannot be replaced. So there are three of the facts: unique, scarce, cannot be replaced, without we can say significant effort, cost, or effort, cost, and time. So we should not be able to replace it without incurring a significant effort, cost, as well as a time. And then comes the input in terms of the situation 2, that we need to meet three conditions. In this particular case, we need to meet three conditions in this case. So here it is either the two set of conditions or one condition. But in this case, we can say we need to meet all the three conditions in this case. So what are the three conditions with me? Condition number 1, we can say the process is critical. We need to prove that the process is critical, underline critical. The second one is that we acquired organized workforce. So let's put it as plus. So we have acquired an organized workforce as well. So if you're able to prove that you've acquired an organized workforce, number 2, and number 3. The third condition is other inputs have also been acquired. Other inputs have also been acquired. So other inputs have also been acquired, which will be converted into output. So apart from the organized workforce, you should have acquired other inputs as well. Underline other inputs. So I hope, friends, I am pretty clear on the permutations and combinations in terms of the IPO test. We'll do some questions now with you, making a walkthrough of the understanding at this stage. So I am carrying some examples with me, and these examples are given by the International Accounting Standard Board. You know, when they got out an amendment, and they gave some examples, the IASB, International Standard Board, gave these examples. I'm going to make a walkthrough with a few examples on those areas with you. So let me now share the examples with you. We are going to now make a run through on those examples with you. Okay, let's have a look at an example, which is a purchase of brand. So I'm just going to first read the inputs and then we'll make our analysis. And let me first make the chain very clear. The first thing is that you need to evaluate whether a concentration test is to be applied or not. If you decide no, IPO test mandatory. If you decide to say a yes and you pass, it is asset acquisition. No IPO test. If you apply and you fail, then it's a mandatory IPO test again. So concentration test is also to be, seen whether the entity is applying it or not. Let's read. It says entity B purchases from another entity S the worldwide rights to product 1, 2, 3. So they made a purchase of worldwide rights. It says including all related intellectual property. In addition, B also purchases all the existing customer contracts and customer relationships, inventories of finished goods, customer incentive programs, raw material supply contracts, specialized equipment specific to manufacture, and documented manufacturing process and protocols to produce this particular product. I think one thing is pretty clear that this company has acquired a multiple of assets for sure, because they are acquiring the worldwide rights. They're also acquiring the existing contracts, customer relationship, inventory, incentive programs, and they're also acquiring documented manufacturing processes. Then he says entity B does not acquire any employees, or he does not acquire other assets or other processes or other activity. The word is not processes, but it is other processes. So it says in this particular case that they've not acquired any other employees as is stated in this particular case. So when it says that they've not acquired anything else in this particular case, we can say that they've not acquired any other inputs. None of the identifiable assets purchased has a fair value that comprises substantially all the fair value of the gross assets. Identify if the transaction is an asset acquisition or it is a business acquisition in the case entity decides to apply the optional concentration test. Now, in this particular case, I think I would like to first of all pinpoint one thing, that the company decided to apply a concentration test. So let's first look at the status of the concentration test. So let me do the evaluations with you. Let's go step by step and let's look at the concentration test to begin with. Now, there is a very interesting language which is stated in the question with which the concentration test can be evaluated. It says none of the assets purchased has got a fair value that is substantially equal to the fair value of the gross assets acquired. There is not even a single assets where the consideration is concentrated. He says if you look at any asset, no asset has got a value which is substantially equal to the step number 2 value, the gross value of the assets acquired, which means this test is definitely failing as per the instructions in the question. And if this test particular fails, then I am required to go to the IPO test in this particular case. And let's now go on a step-by-step basis on the IPO test. So in this particular case, what I need to do at the first instance, identify in this particular case, in my step number 1, that did we acquire inputs and processes as well. So did we acquire the inputs and the process in this case? And I think in this particular case, we can clearly see one thing. It says out here that we have acquired documented manufacturing processes, but he says B does not acquire any employees, and it says other assets or other processes or other activities. I think the absence of acquiring employees, which is organized workforce, and not acquiring other processes as well, I think I would undoubtedly at this stage only say that it is not a business, but I would say it is supposed to be an asset acquisition. Because in this particular case, the company is not acquired any kind of processes major. Yes, they've acquired documented manufacturing processes even you can do one thing, you can maybe go to the step number two. And in terms of step number two, are they having a revenue or not? One could say that yes, if they've got existing customer contracts, they do have a revenue. So even if I don't want to conclude at the step number one, I go to the step number two. Let's do that. So if I were to do that in terms of the step number two, even if you say that yes, I acquired a process for the moment. Let's say I said yes, I acquired a process because they have acquired documented manufacturing processes. I'll go to the step number two. And is the output present? I would say yes, the output is present in this case. How do I know the output is present? They've got existing customer contracts. The customer contracts means the revenue is definitely present. So the output is there. Then I go to the step number three. Now, once the output is present, you need to meet either the two or the one condition. In this particular case, the two conditions tells me that the process is critical. Of course, I'm not given information whether it is critical or not. But then it very clearly says in this case that the organized workforce is supposed to be acquired in this case, and the organized workforce is not acquired. I'm not even given the status, whether the process is scarce, unique or not. So I can't really evaluate the conditions of scarcity, uniqueness, or in terms of criticality. But I think if I even make a walkthrough further, I would say that none of the employees, they did not acquire any employee. So organized workforce is not taken. So one can definitely say that it is an asset acquisition. It cannot be a business acquisition. Right, friends, I hope I've made myself very clear on the application of how you're going to proceed with the analysis. So far, so good. Let's do another question with you. Let's have a look at another question. We'll do another case study. This is also given by the International Accounting Standard Board on the area of the assessment. So let me just read the inputs further to you. It says entity D acquires a legal entity that has got the right to research and development project that is in progress. When it says it is in progress, it definitely means that there is no output because the revenue is not present. That's what we can definitely evaluate at this particular stage itself. Let's see further in terms of things. So we can say now in this particular case, it says the final testing phase, it is in progress of the final testing phase to develop a drug to treat pneumonia, development asset. The development asset is including the underlying knowledge. It is including the formula procedures, the designs and protocol expected to be needed to complete this phase. Then he says a contract that provides the outsourcing of clinical trials. So they have acquired two things. They've acquired number one, a development asset, and they've acquired number two, a contract which is for outsourcing clinical trials. So one thing is very clear that they've acquired two assets, group of assets. The contract does not state which vendor should be used. There are several vendors that could provide these services, and the contract uses current market price. Therefore, this has got a zero fair value. It says there is no option to renew the contract. Now, he's acquired two assets in this particular case. One is a development phase asset and one is a contract for outsourcing of clinical trials, but the fair value of that particular asset is zero. If the fair value of that asset is zero, my mind is telling me that perhaps you've acquired only a single asset. And if you acquired a single asset, then I think the possibility of calling it as a business would not arise in this particular case. That's what is coming at the back of the mind. So let's see further. It says entity D has not acquired any employees, other assets or other processes or other activities. Identify if the transaction is an asset acquisition or is it a business acquisition in case you decide to apply the optional concentration test. So I think let's work this out. To me, if you ask me, I think in this case, I would not be required to go to the IPO test as well. I think if I apply the concentration test only, you can see one thing. Let me just make a walkthrough on this particular part. So let me, I think, first go to the concentration test. If I look at the concentration test, let me first of all identify that in this particular case, you acquired two assets and the fair value of this asset is zero. So can I say the entire consideration is concentrated in the development asset? So if I can prove it out here that the entire consideration, I would say the entire consideration is concentrated. The entire consideration is concentrated in development asset. I'm putting it as DEV, development asset. So if it is concentrated in terms of development asset, I think that test is passed. What is the good need of applying even the IPO test in this case? So if the test is passed, then we conclude it's not a business. It is supposed to be an asset acquisition in this case. I think the IPO test in this case is not required to be evaluated as well. Okay, so I think let's take one more example before we close this out. So, oh no, I think I've just taken two examples only. Yes, I have taken two examples. Yes, there is one more example as well. I thought I'd taken one more interesting example. Let's see one more example, which is very interesting indeed. And then we'll just summarize the conclusions also at this stage. This is also one of the examples given in the International Accounting Standard Board, which is making a mention in terms of things. You know, this takes me down to the memory lane because I remember it was around 2018 or 19 something when this amendment came. And when this amendment came, I'd written an article also pertaining to this particular amendment. And many people, you know, at that time thought, what is this man writing? Sometimes you're speaking, I think, ahead of times, you know, and people really don't appreciate what are you making a mention on. Like, for example, I always tell people, you know, that what is the future ahead in terms of you is sustainability. And I think today people may not be able to appreciate largely in terms of what is the importance of this, but I think the growing importance is growing well. Financial reporting, of course, is going to remain strong, but along with the financial reporting is also going to be the concept of sustainability reporting as well. Like you see the concept of BRSR, the business reporting and sustainability reporting, business responsibility and sustainability reporting in India, which is mandated for 1,000 companies in India. Quite recently, they've also introduced that companies will be mandated for 24-25 to give a BRSR score as well. And that would also decide the fate of the companies as well. Wow. The world is changing. Okay, let's come back to the example on acquisition of a radio station. Let's read. It says an entity sells its radio broadcasting assets. The word is plural, therefore emphasis added because it is plural in nature, indicating that there are multiple assets acquired. Then he says the acquired set of activities and assets are comprising of a broadcasting license, a broadcasting equipment, and a broadcasting studio. Now, in this particular case, I've got some intentions also to tell you that the company has acquired three kind of assets. License is intangible and equipment is tangible. So this is intangible in nature. And if you look at the equipment in the studio, that is tangible in nature. So why are we looking at the fact that, you know, these are tangible or intangible in nature? Reason that when you're applying a concentration test, you also need to consider, do we group similar assets or not? Because as if you remember earlier, I said, you need to see that the fair value of that single asset or the fair value of the similar assets, is it substantially concentrated or not? So you need to see that do we do a grouping in this case? I don't think so. There are similar assets at all. A license being intangible, equipment studio, they are not similar assets. So grouping in any case will not be done in this particular case. We can doubtfully say there are three assets acquired separate. It says at the acquisition date, the fair value of each of the assets is considered similar. If the fair value of each asset is considered similar, that means one third, one third, one third each. The amount of fair value cannot be concentrated in terms of a single asset. Because if the fair value of all the assets are similar, that means the PC, the consideration is not concentrated in any single. No processes are needed to broadcast or sold, and there are no employees or other cost. Entity S has been stopped it has been stopped using the acquired set of activities before it is sold, which means that there is no revenue, so there is no output also which is present. Identify if the transaction is an asset acquisition or a business acquisition if the entity decides to apply the optional concentration test. I think this is a good question indeed. So let's make a walkthrough in terms of the concentration test and the IPO test if required. Let's go step by step. So let's first evaluate the concentration test in this case. So if we look at the concentration test, we can definitely say that this test will definitely fail. And why would it fail? Because in this case, the fair value of the each asset sold is equal. So if you take the fair value of any asset as a percentage of the gross fair value, it's going to be 33.3%, not substantial. And if this fails, then I need to go to the IPO test in this particular case. And when you go to the IPO test, let's look at step one. I think if I look at the step number one itself, I think this will fail, because if you see that did you acquire input plus a process, I think at this stage only we will land up, saying a no. It very clearly says that no processes needed are sold, and there are no employees or other assets taken. So the process is missing. So the answer is a no. If it is no, it cannot be a business combination. It is an asset acquisition. Multiple assets have been acquired. You must be thinking, that all the three questions I've done are concentrating in terms of that it is an asset acquisition. I think if the question is supposed to be a business acquisition, then I think it will be, very clearly telling you the inputs as well. Okay, now I think it's time to do a little concentration in terms of things. Your video is getting stuck. Is it still getting stuck, friends? Please check this again. I think it should be good now. Maybe there could be internet issue. Now it's okay. Okay. Now let me do one thing at this stage. Before we proceed further, I think let's look at a little mind map at this stage. Then we'll take the journey forward. So let me do a little mind mapping at this particular stage. So let's, I think, introduce you a little mind map at this stage. So before we take the journey forward, I guess a little quick mind mapping is going to be helpful indeed. I'm not just going to give the chain in terms of what we have considered so far. I started off with a three-step model in terms of which standard applies. So I started my journey in terms of a three-step model. And in terms of the three-step model, the focus was to decide which standard will trigger. The focus was to decide that which standard is going to trigger in which permutation combination. And we decided in this particular case that when you're looking at this, your step number one is focusing on what did you acquire? Did you acquire an individual asset? Or did you acquire a group of assets? That was a focus point. So one thing is very clear, that unless you acquire a group of assets, Index 103 cannot apply. So individual assets, it is 16, 38, 40, tangible and whatever. Then we went to the step number two, and we said that this group of asset, is it a business or not? Is it a business or not? And in this particular case, the focus was the word business out here. And we've now understood the concept of business. So if you just like to come out of the chain, if I just like to come out of the chain, I can say when you're looking at the business, then I gave you that there are two tests in terms of the business. We just do a little offshoot in terms of things, and we have understood the chain further, mind mapping. So in terms of the two tests, we decided We decided in this case, one is the concentration test. We decided one is supposed to be the concentration test, which we said is purely optional in nature. And the other is what we call an IPO test, which is, of course, mandatory in nature. We saw the nitty-gritties that in terms of the concentration test, we said that it is optional. You pass, it is asset, you fail, you go to IPO. You don't apply, you go to IPO. We'll come to the chain. Let's come back first and finish the chain out here. So when you said it is a business or not, if you said yes, it is a business, then we went to the concept to see that the control is there or not. Then we went onto the focus to see the control is there or not in this particular case, and your focus was in terms of control. I did not speak in terms of control much, but I just gave you that it is a principle-based assessment. So this was the basic chain, the focus being more than one, business and a control. Only then Ind-AS 103 apply. If I forget about the other standards, the focus point for 103 is a three chain. You acquire more than one group of asset, it is a business too, you get a control. Only then 103 applies. Any one fails, 103 is not applicable. Now we came back out here and we said this is also got a three-step model. And we came out here IPO and we also said this is also a three-step model. So you can see that I have given you the chain very clearly. The basic structure in terms of three-step, then within the two, you've got three-step as further. So in this particular case, when you started looking at the inputs, in terms of the three-step model, let's take a quick view on this. In the concentration test, we said in your step number one, you need to add the PHI plus the consideration transferred and plus the amount of NCI to get what is paid for the 100% of the net assets. So when you do this, you're basically getting what is paid for 100% net assets. You're basically getting the information that what is paid for the 100% net assets. And then we say that there is a need to translate this in terms of you take the value in step number one, and to this you add the liabilities which are actual in nature, not notional in nature. And you reduce the amount of cash and cash equivalents in this case. When you do this particular plus and minus, you are basically getting what is paid for assets other than cash and cash equivalents. So you're translating this in terms of what is paid for the assets other than cash and cash equivalents. And then you go on to the step number three, and in this particular case, you take the fair value of the highest fair value of the, or we can rather say we take the highest fair value. So we'll take the highest fair value, whichever asset has got the highest fair value. You divide this by step number two and you get a percentage to decide the data. If this percentage is more than 90 or more than 90, then this test pass, it is asset acquisition. Otherwise, we go to element test. Okay, now coming forward in terms of the IPO test also, we decided in terms of step number one, did you acquire input and a process? The focus is more on the process. And in this particular case, if you say, yes, we've acquired the input and the process, you go to step two, where the focus is in terms of identifying the output is there. The output is represented by the presence of revenue in this particular case. And when you look at the presence of the revenue in this particular case, you may have a revenue or you may have no revenue. Then we go to step number three. In this case, there are two conditions or one, and in this case, there are three conditions which need to be met. So the two conditions out here is the critical and organized workforce. The one condition is that it is supposed to be unique, scarce, or it cannot be replaced without significant cost, effort, and time. And in this case, the three conditions are critical, organized workforce, and other inputs. And accordingly, you decide whether it is an asset acquisition or not. So this is the entire chain which I gave you. And in between this chain, I also gave you another input as well. That when the group of asset is not a business, when the group of asset is not a business, we also learn the art of split. We also learn the art of split in terms of relative fair value ratios. Relative fair value ratios, and this is what we did to remind you in terms of illustration 1 of the study map. Wow. I hope, friends, now you've got the entire chain, the map clear in terms of how we're going to think. So you did the journey in terms of entry 3-step model, and which gave rise to another 2 3-step model, the business testing in terms of concentration, the business testing in terms of the IPO test. The background is made. Now I'm going to make more backgrounds to you. So far, so good, I guess, friends. You're all absolutely clear with the chain of thoughts, I guess. Now it's time to make some backgrounds to you as we go ahead to the next year. I need to make some backgrounds to you at this particular stage. So the next 10-15 minutes is also going to be crucial. I know your mind must be feeling a little heavy, but this is the right time to make some entry points in your mind. I am now formally going to start with Index 103. Oh my God, what I was doing for the last so much time. I was basically trying to introduce you to the concept of 103. Now we are formally entering the concept of 103. Now watch this carefully. Watch this carefully. I am now looking at the standard 103, which is business combination. The name of the standard is called business combination. Now, at this stage, one thing is very important to introduce you, because this will decide a fate of a lot of things. Trust me, friends, what I'm discussing right now, the next 10-15 minutes, very crucial, because this will decide the fate of a learning in the next 4 sessions. I'm going to consider 3 examples in front of you. Watch those 3 examples carefully as we unfold the concept of the kind of accounting which will apply in terms of the standard. Let me do one thing. I'm going to give you a total of 3 examples at this stage. And watch these examples carefully to get the basic feel of the standard. I'm looking at a situation number 1. I'm looking at a situation number 2. And I'm looking at a situation number 3. So let's consider that there is a company A and there is a company B, and company A acquires the business of B. And let's also consider that in this particular case, it is a business and the control is acquired as well. Let's consider a very simple case where the company A has got, let's say, 100 shares in the company and B has got 60 shares in the company. This is the status of number of shares which company A and B has got. Company A tells the shareholders of company B that I will give you shares in my own company in the ratio of 1:1. The company A approaches the company B shareholders. I'm not approaching B. I'm approaching the shareholders of B. So A approaches the shareholders of B and tells him that I will give you 1 share for every 1 share. So B will be given, the shareholders of B will be given 60 shares. I want to calculate post-acquisition. I want to calculate post-acquisition what is the percentage stake of A. The shareholders of A have got 100 shares in the company, and the total capital base of company A is now going to become 160 shares. Because company A in this particular case, you can say, is giving 60 shares to the shareholders of B. So we're looking at the status of company A shareholders. He's got a total of 100 shares and he's given 60 shares to the shareholders of B. So his total capital base becomes 160. Let us see what is the percentage which A gets. The shareholders of A have got 100 shares out of 160 shares. That means their percentage or stake is 62.5. You must be thinking, so what do you want to prove in this particular case? Well, I think one thing is pretty logical that if a company acquires another company and pays the considerations by way of shares, they will definitely dilute their own percentage. Because I am giving shares to another company shareholders and they will become the shareholders in my company. So my stake will definitely get diluted. So from a 100% stake, my share has got diluted to 62.5. But what is the important aspect at this stage is that company A is still in control. The company A is still in control of the business. They're still in control. The shareholders of A are still in control. You acquired somebody's business. You paid a consideration to the shareholders in terms of shares. But in spite of giving them shares, your percentage gets diluted when you're still under the control of your own company. This is what is give rise to what is called acquisition accounting. The standard says this gives rise to what is called acquisition accounting. So one kind of accounting you will see in Ind AS 103 is called acquisition accounting. Let's take another example, situation number 2. Let's take a similar example. Let's say there is a company A which takes over the business of B. So let's take the same status that the number of shares company A has got is 100 and let's say the number of shares company B has got 60. But this time, let's say the company A tells the shareholders of B that I'll give you, let's say 2.5 shares for every 1 share. I know you cannot give shares in decimal, just for understanding. So let's say the company A tells the shareholders of B, I will give you 2.5 shares for every 1 share in your company. Which means I will land up issuing 60 into 2.5, that comes to 150 shares to the shareholders of B. So I want to again calculate that post acquisition. I want to again calculate that post acquisition, what is the percentage stake of the company A shareholders? What is the percentage of A company shareholder when they land up issuing shares to them? So they've got a total of 100 shares in the company. And they will land up issuing 150 shares to the shareholders of B. So which means if I want to calculate the percentage after A gives the shares to the shareholders of B, so we can say they've got 100 out of 250 shares, which means that the percentage comes to 40%. Oh my God. You can see the status of change in the exchange ratio has led to the fact that A has got a loss of control. He loses the control. He is the person who is paying a consideration to the shareholders of B, and in the entire process, after giving a consideration, he loses the control. Indirectly, we can say it is B who gets a consideration, is getting a control over the business of A. So in this particular case, I would say that A, in this case, loses control. He lost control in this case. There is a loss of control in this particular case. And this is what is called reverse acquisition. This is called a reverse acquisition, that when you acquire the business of somebody else and you pay a consideration and the person getting the consideration also gives you a second kind of accounting that is called reverse acquisition accounting. It is called a reverse acquisition accounting. So far in this, and I am still in control, because one thing is very clear on a logical level. If I acquire somebody's business and I pay a consideration, he becomes a shareholder in my company. Solution could be of such an extent that even you lose the control, if you are at the very inception to decide that is it acquisition or reverse acquisition? Yes. If you look at Ind AS 103, the main standard is giving you a guidance on acquisition accounting. If you look at the reverse acquisition, it is the Appendix B, which is giving you the guidance on reverse acquisition. So there is a separate guidance which is given in the standard. We can say acquisition accounting is addressed in the main standard itself. And the reverse acquisition is addressed in the Appendix B of the standard, where we're given specific inputs in terms of what is the case of reverse acquisition. And that's not the end. We've got another third situation to look at as well, which is also addressed in the standard. Let's take an example. Let's take another example out here. So let's say there is a company A and let's say there is a company B. So let's say there is a company A and let's say there is a company B and let's say there is a company C as well. Now, let's consider A is having a control over the business of B. He's got a control. B has got a control over C. So A's got a control over B and B has got a control over C. Is C a subsidiary of A? Yes, of course. Because if A controls B and B controls C, C is also a subsidiary of A. Now, in this particular case, A decided to acquire the company C. You will say, why would he acquire the company C? I mean, in the sense that I want to bring it directly as my own subsidiary. So in this particular case, you can see one thing, that in this particular case, A was under the control of C earlier also, and A is under the control of C. C is under the control of C even after. Or you could even take another example as well. I think that would be a better one. So let's give you another example out here. Let's consider that A is got two subsidiaries, B and C. Let's say E has got two subsidiaries, that is B and C. And in this particular case, company B tells C that I want to acquire this. So you reorganize the structure that instead of A getting a control over B and C, A gets a control over B, B gets a control over C. Now, in this particular case, what you can notice is that both these companies, B and C, before and after the reorganization, is under the control of A. The company B and C were under the control of A earlier. The company B and C are still under the control of B and C again. There can be more examples, like a case of a demergers as well. I think let's give you a small little further example as well. Let's consider there is a company A Limited and there is Mr. X who has got, let's say, 80% stake in this company A. Hear this carefully. So let's say there is a company A and there is Mr. X who's got 80% shares in this company. Company A Limited decided that they've got two divisions and they want to basically demerge one of the divisions and create a new company. So this company is, let's say, got two divisions. So they decided that they will get a company A and they will create another company B. So let's say the division, let's keep the name of the divisions. Let's say the name of the division is, let's consider W and U. So they decided to keep this W division with itself and create a new company with a U division. That's called a demerger. So the company A has got two divisions. They decided to, retain W division and transfer the U division to a separate company B. And what they decided, the consideration, Mr. X has got an 80% stake already in this company. The consideration of this company B is also paid to the shareholders of the company itself. So the company B shares are allotted to the existing shareholders only. So the shares of A Limited is with Mr. X and the other shareholders. The shares of B is also given to the shareholder Mr. X and other shareholder. So the company A and the company B is still under the control of the same set of shareholder. Mr. X had a control over A earlier also. He's got a control over A now also. And Mr. B is also under the control of Mr. X. This is what is technically called a common control transactions. It is called a case of a common control transactions, in which particular case we are saying that if the transactions are happening, you can say between the companies. The transactions are happening between the companies which are under the common controls of the company. The companies where transactions are happening before the combination, after the combination, the control is with the same party. We'll be coming to this part also, and this is addressed specifically in the standard in Appendix C. So, moral of the story which I want to give you at this particular stage. When you look at Index 103, there are basically three kinds of practical illustrations and three kinds of accountings which you're going to confront. One is a case of acquisition accounting, where it's a normal situation where you are, and I would like to tell you at this stage, situation 1 and 2 would occur between unrelated parties. And situation number 3 will occur between related parties, which means when business combinations is happening between unrelated parties, you're going to see that either it is a case of acquisition or a reverse acquisition. So you'll have to sit down and see like this. Okay, is the transaction between unrelated party? Okay. Is the percentage diluted and you're still under control? Yes. Acquisition accounting. If the percentage got diluted and you lost the control, reverse acquisition. And if the transaction is between related party, you could be under Appendix C. You could be under Appendix C. Even if it is a related party transactions, you may still fall back on step 1 and 2. So moral of the story is, your focus point in terms of the question to begin with is transactions is related, unrelated. If it is unrelated, either acquisition, reverse acquisition. If it is a related party, evaluate is it Appendix C. If not, could be acquisition or could be a reverse acquisition as well. So what we are going to do, friends, in the next year now, I will be, starting one by one. So what I'll do, at this stage, we will concentrate only in terms of acquisition accounting. Once we're done with the concept of acquisition accounting, then I'll come to the concept of reverse acquisition. Once I'm done with the concept of reverse acquisition, I'll come to common control transactions. So we will study these three kinds of accounting one by one. In terms of acquisition accounting, I have created a 7-step model which I will open up in the next class with you. Rather, I would say I'll open this up in the next year with you. I think that seems to be quite good for the day. I guess you must be feeling a little heavier as well. No worries. I think even if you are, that's perfectly okay. But I think before we end for the day, I think I want to take the opportunity in terms of wishing you and your family a very happy and a prosperous new year to head. Hope this year brings you a lot of joy and happiness and prefixes the name of the chartered accountant in front of your name as soon as possible. So my best wishes and my good wishes to you and your family. A very happy new year to all of you.
Thank you,
Thank you
sir.
very
Happy
much
New Year
indeed.
to you also.
Thank you, Vida. Thank you so much. This year is ending with a very interesting class of the morning. Thank you. Thank you very much indeed. Right,
Happy
friends.
New Year, sir.
Thank you very much, Vida. And same to you, same to all of you. Thank you very much. Right, friends. So I think it's time to bid goodbye now to you. So I'm going to see you in the next year now. So bye-bye, take care, and please keep doing your cumulative revisions as well. Bye-bye. Haji, thank you. Happy New Year, Ji. Thank you.